Welcome to the Market Recap, your weekly digest of the biggest market stories from the past week. Join host Anna Sarin and financial expert Bruce Campbell as they go beyond the headlines to deliver cutting-edge insights into news that move the market. Proudly presented by the Canadian Securities Exchange.
Welcome, everybody, to CSE's Market Recap for the week ending April 1st. I am James Black with the CSE, and I'm joined today by Jordan Youl. Sometimes it's Bruce Campbell. Today it's Jordan Youl, and we're talking about the market, what happened this week. From your vantage point at StoneCastle Investment Management, it was another crazy week in the markets. Obviously, everything that's happening geopolitically, what's going on in Ukraine. We're going to talk about the release of oil reserves in the U.S. and the impact on inflation. And then more news in the cannabis sector, which has obviously been through more ups and downs than probably any other sector in the last couple of years. But let's start off first, Jordan, with what's happening in Ukraine. This is obviously the biggest geopolitical event in quite some time. And the relationship between Russia and North America and the flow of oil. Joe Biden comes out this week, says we're going to release over the next 6 months an unprecedented amount of oil from the U.S. reserves. What is this going to do to the market? What does that do?
Yeah, well, it really depends on the market specifically. But if we speak specifically towards commodities and oil prices, this week in particular, oil or WTI has declined around 12%. It's trading around $100 right now. But, when I was on the show a few weeks ago, we talked in length about this massive commodity spike that we really haven't seen in multiple decades. And there's pros and cons to that. So, the issuers, the energy stocks have, fared a lot better and performed well with rising commodity prices. Some, in fact, have, even increased their dividends and share buybacks and what have you. But on the flip side, it could be detrimental to the economy to a degree. So if commodity prices spike and increase too much too quickly, that could have a potential negative effect towards the economy. So, as you mentioned, President Biden announced a unprecedented release of, 1 million barrels of oil per day over the next 6 months. So obviously, that's something that, is weighing on the underlying spot price and the commodity price. But if you look at the issuers, and an ETF is XEG, which tracks, the domestic Canadian issuers, it's actually performed, quite well on a comparative basis. I believe, last time I checked, it was down around maybe 1.5% on the week. So on a comparative basis, it hasn't declined as much. So it really depends. But yeah, we still are seeing opportunities though, outside of commodities for new ideas moving forward. But what we are watching carefully and closely is obviously the Russia and Ukraine narrative. That's top of mind. But maybe a bigger narrative or bigger concern is the fact that at home here domestically, we are still fighting, record high inflation. And, with midterm elections coming up this year as well, there's a lot on the table for the U.S. President Biden, his political numbers are not very high right now. In fact, they continue to decline. So there's a lot on the table right now. But yeah, it's something that we're watching very closely.
Right. Yeah. No, a lot going on. And obviously pain at the pump
Exactly.
over the summer when gas prices typically do go up. So it's going to be if you drive a lot, it's going to be a difficult summer. When you get to the pump, you might hold off on buying that extra Gatorade or chocolate bar or whatever, because you ended up paying, over $100 to fill up your tank. So maybe just go fly somewhere. Okay. So that aside, we know that's going to be an ongoing issue. Talk to me about the yield curve inversion and the risk of recession. So obviously, we've over the last few years had a very, bullish economy, but now with inflation, we are going to now look at the risk of recession. Excuse me. Tell me what's at play here.
Yeah, so we fielded a lot of calls and inquiries this week about the 10 and 2-year U.S. Treasury yield inverting. It doesn't happen very often, but historically, if you look back, anytime the yield curve inverts or turns negative, a recession occurs. But we are reminding investors, for the most part, not 100% of the time, but most of the time it does. It's a good gauge to determine whether or not a recession is imminent or what the economic backdrop is telling us. But we are reminding investors that, despite the yield curve inverting this week, it's more of a dimmer switch than a light switch. So if you look at the equity markets, and we'll use the S&P 500 as a proxy or barometer for the equity markets, anytime the yield curve inverts, the S&P 500 on average does not peak until about 18 months later after the inversion. And over that same time period, the average return for the S&P 500 is about 19%. So in other words, it's something we need to be cognizant of, but it's just one economic data set that we want to watch. Another indicator that we follow that includes the yield curve and other factors is the US LEI index, the leading economic indicator. And, last month, that particular indicator, in fact, turned positive. So what we like to follow for that index is the 6-month rate of change. And in simple terms, when that rate of change turns negative, there's a very high probability that we're going to go into a recession. We're not there yet. So we're still above that zero line. I think I referenced that last time I was on the program. So that's another tool that we're watching. But, the unemployment rate is at 3.6%. The labor force participation is increasing, and wages are increasing as well. Unfortunately, not as high as keeping up with inflation, but that's positive, right? So the takeaway here is, when you put it all together, the narrative is, is a recession imminent? We don't think it's in the cards in the very near term, but it's something that we're cognizant of and watching closely.
Right. And so for everyone watching, a recession is defined as a significant decline in economic activity spread across the market, lasting more than a few months, normally visible in real GDP, real income, employment, industrial production, and wholesale retail sales. So we're obviously looking at a scenario here where there is pressure on the economy, and we fingers crossed. I mean, recessions happen. We live through them all the time. It's not the end of the world, and they almost are necessary, I assume, to have a healthy, thriving economy in times of good. But certainly, you got to be ready for them as an investor. So be warned. All right. Positive signal in small caps, risk on. Okay, so when you say positive and then you say risk on, I'm confused. Explain this to me.
Yeah, exactly. So obviously there's a lot of cross currents. So, from in the context of an investor, there are, asset classes, for example. So in our asset leadership model, we're effectively ranking different asset classes to one another using technical indicators and relative strength to one another. And, as expected, commodities, for example, have been the strongest to, say, fixed income, for example. But despite, commodities, outranking other asset classes, there are geographic regions. A lot of these commodity-rich regions like Canada, South Africa, Peru, Brazil, for example, Saudi Arabia, that have performed very well in this environment, that thrive when commodities lead, where, the S&P 500, for example, had, one of the worst quarters in 2 years, right? It's
Right.
April 1st, it's day one of Q2. So despite, all the narratives and the geopolitical tensions and all the noise out there, there are opportunities in select geographic regions and market caps and industry groups that are opportunistic today and right now. And one of those is specifically TSX, or Canadian focused small to mid cap growth stocks. So we have a chart. It's a relative rotation graph. It's one of the technical tools that we use at StoneCastle.
A hallmark of this program, by the way. If you've never watched it before, you would love this.
Exactly. And, it's a great visualization of trends and what is in favor. And as an investor, you always want to be, on the right side of that trend and capitalize on what the market's favoring and rewarding right now, as opposed to, maybe positioning the portfolio for a potential outcome that may or may not ever come to fruition. So in this relative rotation graph, there's 4 quadrants. There's improving, leading, weakening, and lagging. And what I've done here is I've separated the market. So we're taking the entire US stock market and comparing it to different market caps and versus the growth and value narratives. So on the left-hand side of that vertical axis, we have small cap, mid cap in the improving quadrant, and large cap trending in a positive direction in the lagging quadrant. Now, these trends typically last for multiple quarters, and it typically rotates in a clockwise fashion. And on the right-hand side, you can see in the green leading quadrant, the value constituents. And it's been a tug of war over the last couple of years between the growth versus value narrative and what's been, really driving the markets. And for the last couple of quarters in particular, specifically, it's been predominantly large cap value stocks, driving the market. Well, we're starting to see that rotation out of value and money flowing back into the small to mid cap growth areas of the market, which have been really underperforming and out of favor for the last couple of quarters. So from a timing perspective, we believe that, small to mid cap growth is an attractive entry point right now, specifically in Canada. And I do want to, stress that point, because in Canada, the small to mid cap issuers, or the makeup of the TSX small to mid cap index, is very different than the US, Russell 2000, for example. We're still a little bit more tilted towards the commodity rich issuers, right? Whereas, the US or south of the border has a little bit less exposure. So the makeup of the two indices are very different. So yes, we're cognizant of the macro, risks and the economic backdrop and whatnot, but internally, selectively, there are opportunities here at home in the small to mid cap growth areas of the market that have been really punished and out of favor for the last year.
Gotcha. Yeah. And obviously small cap and mid cap by definition in the US usually indicates a bigger company than what we call a small cap or mid cap in Canada. But in general, do you see similarities between, the style of company on both sides of the border by definition of small and mid cap?
Well, yeah, you're definitely correct and right in that, what defines a small cap issuer in Canada would be like a micro cap in the US, right? So the market cap is different, without question. It's a bigger market in its entirety in itself, right? But yeah, between, cannabis, the precious metals, the base metals, which have been performing well, energy's been strong, as you know. But, with this value versus growth narrative potentially flipping or switching back, favoring growth, we're seeing a lot more technology names, right, starting to perk up again, right? So, and I think that's really important, because as investors, we want more industry groups and sectors participating and performing well as the markets are hitting all-time highs. And what I mean by that is the TSX specifically. The Toronto market is close to all-time highs. South of the border still has, some of their work cut out for themselves. But at home here, there's a tremendous amount of opportunity. And, if you go back to the last couple of months, what's been leading or really holding the TSX higher has been predominantly energy and materials. But now we're starting to see industrials, discretionary, cannabis, technology, all starting to reaccelerate again. And, one of the really simple technical indicators that we follow is, the percentage of stocks trading above, their 50-day or 200-day moving average. And a few weeks ago, it was around 30%, which was not very constructive or positive. Well, today we're high 60s. Right. So we're starting to see some more buying power and accumulation in some of these stocks in other industry groups other than, energy and materials.
Yeah, we're staring down the a recession potentially, or at least conditions leading to one, and record, inflation. So it's incredible how the market works.
Yeah. And, I think what's really important as an investor, we all have our reasons as to why we're investing in a company. But it's really important to know when to exit and have your stops in place, because, you will be wrong at some point. And, the market is bigger than us and, smarter than us. So, if our narrative changes and we get stopped out, we need to exit and reevaluate to preserve our capital. Right. So we're constantly active in adjusting our asset mix based on the current market conditions and the rotations that are taking place. But at the end of the day, we know exactly when to exit a position if it's going against us. And it's really important for the viewers and investors to, have that mindset of knowing when to exit a position.
Yeah, you gotta keep your eyes on the prize. Okay, well, let's talk about, there was a good segue there to the cannabis industry and the MORE Act. So what is the MORE Act? Well, this is April 1st. No joke. U.S. House of Representatives passed federal cannabis legalization, the Bill MORE Act. Legalization Bill, MORE Act. Let me get that right. What exactly is this in short strokes? This MORE Act is a proposed piece of U.S. federal legislation that would deschedule cannabis from the Controlled Substances Act and enact various criminal and social justice reforms related to cannabis, including the expungement of prior convictions. So there's been a lot of legislation that has been put through Congress, is sort of died on the process as it's gone on to Senate. Now, in your mind, if you studied the MORE Act at all, if you looked at it, I mean, all we know is that when these things hit the docket, they tend to give the market encouragement as far as the U.S. multi-state operators are concerned, as far as their stock performance, or at least the interest in trading these companies. So we'll talk about a couple of these in a minute. But if you had an eye on any particular movement as a result of the MORE Act, are you at all optimistic this is a step towards descheduling, or is this just another valiant attempt at mimicking what we have in Canada, which is a legal framework?
Yeah, so a lot of good questions. We addressed this last year on the show. The hurdle is the Senate, right? The House vote is one thing, but it's the Senate that they need to get through. So we'll see what the aftermath is, or what's tabled, or how that comes to fruition. But there's no denying the excitement in the cannabis issuers and how they performed over the last couple of weeks. Cannabis, the sector in itself was down by considerable margin, one of the worst performing sectors for quite some time. But a lot of these MSOs specifically have really rallied over the last 1 to 2 weeks. The House voted in favor this morning, which is great. And shortly thereafter, the MSOS, which is the ETF that tracks multi-state operators, started to go up in value, I guess, in light of that announcement as well. So we're starting to see some positive price action and price movement after the announcement this morning.
Mm-hmm.
But yeah, we'll see. Obviously it's a midterm election. This was on, President Biden's agenda. He has, a lot of work to do, and, to save his presidency effectively, this is one of the things that he really wants to push forward. So we're definitely hopeful. We all understand the positive effects it has, whether it's, creating tax revenue for the states. Obviously, imprisonment, prison populations are overflowing, capturing market share from the illicit market as well, M&A activity, just issuers having access to capital as well. Like the list goes on and on and on. But, in our models, when we screen for companies that are improving, both from a fundamental perspective, but also from a technical perspective, we're seeing a lot more cannabis names on that list, which is very exciting and encouraging. And that kind of echoes or kind of coincides with my point earlier that we're starting to see, some of the growthier names starting to perk and get a little bit more of an appetite for investors to put to work to generate some potential strong returns over the next 12 to 24 months potentially, because a lot of these companies have recently hit 52-week lows. They've declined by considerable margin off their most recent highs, but we're starting to see them base and reaccelerate again. So we're very bullish and excited about the sector, but yeah, in the interim it has to get through some of these hurdles first. Yeah,
so in that vein, we'll bring the show over to the CSE Issuer news a little bit, because last week we failed to mention that Cresco Labs, CL, listed on the CSE, has entered an agreement to buy their competitor, Columbia Care. So Columbia Care also has locations in places like Florida where they're both competing. So this is meant to be, one of those 1 + 1 = 2 types of, or 3 transactions where, sorry, I'm good at math, but I'm also bad at math. One of those transactions where, the two entities can come together, have economy of scale, reduce some of the overlap that they have in their operations, and obviously deliver a tighter, seed to sale infrastructure, and obviously create better profit out of operating in this space. So that's one to look out for. I don't know if you have any comments on the specific deal. I know it's one of a couple big ones that happened the last 2 weeks, but
it's definitely one of the bigger ones, bigger deals anyways. The combined footprint is about 130 retail stores, 17 states. and based on the population, it reaches about 55% of the US population. But as you mentioned, yeah, there is some significant overlap. So they're going to have to, divest, some of their assets. But with, with those sales specifically, that's going to free up a lot of cash flow to pay off some debt, which is going to obviously improve the company's value and profitability. So, at StoneCastle, we follow the sector closely. But yeah, I think the opportunity set moving forward is definitely in the MSOs, the multi-state operators for sure.
Yeah, is cash flow going to be an issue for these guys? Is it going to be hard for them to access it through either debt mechanisms or, certainly I don't see a lot of equity offerings in the coming year. But do you think this is an issue for these operators if they can't become cash flow positive?
Honestly, yeah, the MSOs are in very good shape. From a valuation and cash flow perspective, a lot of them in their revenue has increased by an exponential rate year over year. They're in pretty good shape, but it's selective too, right? It's not evenly distributed across the entire sector, right? So the larger cap MSOs, the CSE issuers, are the ones that you definitely want to focus on right now.
I'm not going to disagree. Okay, another deal was Riv Capital. So Riv is another player. It's formerly Canopy Rivers. They also had a deal this week, and that is to buy cannabis chain Etain for US $247 million. No small amount of dough. Now this deal is actually being financed by a subsidiary of Scott's Miracle Grow. So you might know them through other ways of growing things in your lawn and whatnot. When it closes, Etain's owners will hold about 16% of its issued and outstanding Class A common shares. What really struck me about this is really about the company is that Riv Capital says Etain is a woman-owned and operated, one of the state's original 5 medical cannabis license recipients, and has 4 operating dispensaries. So a lot of people in the cannabis space are really looking at New York as sort of this bellwether of how to do it right, social equity, paying it forward to all the people that were originally operators in the space when it was illegal. So again, Riv Capital is now looking to be Etain. Again, just New York being what it is, I think this is a good signal that marketplace now has more capital flow. But yeah, again, don't need you to say much on it, Jordan. Just any thoughts on, again, the M&A. Is this the first of many deals you expect to see this year? Are you going to expect more of these companies that may have traditionally gone public just opt for the takeout and just join one of these big MSOs?
Yeah, exactly. Without question, there's going to be a continuation of M&A activity, and especially as regulation relaxes somewhat, especially in the U.S., where investors or institutional money managers have access to cannabis stocks and whatnot. It's going to create a tremendous amount of opportunity for capital raise. But with Riv Capital, for example, they've gone from cannabis investor to Etain, which effectively is a licensed operator in New York. So now this new CEO, we're going to have to, stay tuned and whatnot. It seems like he's very knowledgeable and has a fantastic background, and he's more than capable of running the company. But yeah, we're gonna have to watch it over the next few quarters and just track it closely. But it's definitely an exciting time for sure in the cannabis sector for investment opportunities.
Okay, I wasn't gonna get out of April Fool's Day without debunking or at least trying to make sense of something I read on the internet today. So I'm just going to read the headline and then we're going to react. So $300,000 Dolce & Gabbana tiara you can only wear in the metaverse. So this actually happened. Jordan. So a one-of-a-kind electronic Dolce & Gabbana tiara fetched over $300,000 at an auction recently. The digital luxury market is in its early days here, but this seems insane. I've had one report I read here on the Wall Street Journal that Morgan Stanley expects the luxury digital item market to be upwards of 55.2 billion by the year 2030. Are you buying it? Are you putting your clients into metaverse assets as we speak? Are we going to be all stockpiling tiaras in the metaverse in the near future?
It's wild. No, like at the portfolio level, we don't have exposure at all. But, I know a year ago when I was on the show, the hot topic was NFTs and how ridiculous some of these NFTs were going for. And effectively, I guess as long as there's somebody out there willing to pay and create a market. It's not going to go away anytime soon. But reading the headline, it's crazy. I don't know if it's just based on ego or whatnot, but a lot of these investors just like these one-off, collectibles effectively that they can talk to their friends about and have in their portfolio. Will it go up in value or not? I don't know, but it's pretty bizarre.
Yeah, and I suspect a lot of this thing is being propagated by the concept that these are unique items. They are not not a non-fungible token. It's each one, even if it looks in the same digitally, have its own independent serial number. Only one person can own one of one, and just like you can own one piece of art in the real world. This is what they're equating it to. And I'm not going to say if I buy it or not. I'm currently out in my own portfolio of this stuff, but I feel like, man, you look at enough of this stuff over time, you start to realize, someone's making money right now on it. And am I going to miss an opportunity here of a lifetime? I don't know. But fundamentally, this has to drive you nuts that this is actually something. So,
yeah.
Okay.
The big question is, when you see things like this, is this a market top, right? Is this the end of the economic cycle? Who knows? But we'll see.
All right. Well, that was a longer one. Thanks for joining me today, Jordan Youl, StoneCastle Investment Management. I'm James Black at the CSE. Stay tuned. Next week, we got Bruce Campbell and Saren returning to the chairs. Thanks for joining me today, Jordan. And if you're watching today, don't forget to subscribe and join us at the CSE every week for the CSE market recap. Thanks again, Jordan. Really appreciate it.
Thanks for having me.
Thanks.